It was another volatile day on Wall Street as we saw the S&P 500 and all the other major US indices down more than 3%. Now, this was actually the sixth time in the last 9 sessions that we've had either an up move or a down move of over 3%. So extraordinary volatility across the board yet again. We saw 29 out of 30 Dow stocks fall here today. We also saw the VIX go up to 40 today yet again. And then we saw interest rates plunge even further. So chaotic week that followed last week's chaotic trading as well. And we'll see what tomorrow brings. But we'll take a look at all that, see how our posture stands. We'll then get into a trade application example where I'm going to focus on a long-term investment opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 5th, 2020. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe on our channel, then go into our description area and sign up for our email distribution list. That way you can be entitled to all the stocks in the S&P 500 that are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not following me yet, be sure to do so. My handle is @BrandonVanZ, and we appreciate those of you that click like and retweet on these Market Outlook related posts. Then lastly, we have a presence on Facebook as well. Join our group by going to the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. As you can see, I've got chart 6D pulled up here in front of us, and I used to say that it was fairly rare for me to pull this up because I try to pull this up whenever we have a volatile day with extreme price moves, but as I mentioned in the intro, it's actually been more commonplace to pull this up as opposed to not pull it up lately with all of this extreme volatility. As you can see kind of in the middle of the screen off to the right, the size of these bars, these green and red bars, are basically telling you how much of a percentage move did the S&P 500 have on any one given day. And as you can see, these towering bars here that are going higher on the green and then plunging lower on the red are much greater in size than what we saw even back here in July and August of last year, which we used to look at as a little bit more of a volatile period. But at this point, I think people have mostly forgotten about that era and have become fixated upon what we're dealing with right here, which is truly extraordinary. If you're newer to the markets and you're kind of feeling a little bit queasy and wondering if this is normal, it's not. We're experiencing some historical volatility moves from day to day here recently, where it just seems like one day the Dow's up 1,000 points, the next day it's down 1,000 points. It's really quite extraordinary. So wanted to bring that up as we kind of get a feel for what type of a market we're in right now. And without a doubt, this is a volatile, chaotic market that we continue to be in. And of course, a big reason behind that, the coronavirus news. Each and every day, we try to dig through, look for new information. And I think the market is kind of bracing for the worst at this point, understanding that while the coronavirus itself may not come out to be a awful incident in human history, it will very well be a major economic hit as people decide to start cocooning and staying at home, watching Netflix as opposed to going to the movie theater. And you know, we had a good conversation in my question and answer session earlier today. So for those of you that are premium members, feel free to check out that recording on our website. But I, talked about things like restaurant stocks and which types of restaurant stocks would I be more interested in than others as a result of some of the sentiment change that we're feeling on the consumer end, along with things like airlines and hotels and cruise ships and all that. We talked about all that today in the Q&A session. So feel free to check that out if that's of interest to you. But without a doubt, it is going to change consumer behavior. And the real question is how long that's going to last. We're all hopeful that a resolution can be found sooner rather than later. But I think we all recognize the reality of the situation, and we just don't have a handle on it right now. So it could very well go on for months while people decide to not go out quite as often as they used to. And if they're not going out, they're probably not spending as much money. Now, there are going to be certain areas that tend to do a little bit better than others. And Costco reported after hours tonight. And I'll show you here on the trade tab. If we were to look at Costco, it is trading just a little bit actually it's about flat right now. It was a little bit higher after they first announced their report. But actually right now it is trading about exactly where it closed the session. So just be aware, we'll just have to see tomorrow morning how Costco goes. But obviously you guys have been hearing and seeing the long lines at Costco, and the empty bins where hand sanitizer and toilet paper and bottled water used to be. In fact, if we were to come on over here and look at the Market Watch tab, I wanted to share something with you in terms of the heat map. This is the Dow Jones heat map. I mentioned in the intro that 29 out of 30 stocks in the Dow fell today. So you might be wondering, who was that one and only one that managed to finish in the green? It's right here, lowly old Walgreens Boots Alliance. And some of you that watched this video will recall that it was exactly 1 week ago in this presentation where we bought just common shares of Walgreens as a long-term investment. So I was happy to see that it was the only Dow Jones stock that was up here today. In fact, the last 3 times I've done this presentation, I've done long trades, and all 3 of them were up today, which is quite a feat considering that if you were to look at the index watched as just an example, in the S&P 500, there were only 21 stocks that finished higher today. So this last Tuesday, I talked about Gilead. It was higher by a little bit today as well. And then maybe a week and a half ago or whenever it was, I did a bull put spread on gold. So the point is, there are some places where you can have some benefits. It's hard to see that, right? Because we look at the rest of our portfolio and it's just in meltdown mode. But there are some areas of the market that can have a little bit of levity, even if it seems like it is a completely dire situation. So was happy to see that Walgreens, Gilead, and gold were all up here today. So let's keep it rolling. Real quick here, if we were to pop on back to the charts now, let's go ahead and take a look at our normal chart setup, which we usually start with chart 4B. I wanted to show you the Foregrip, and this will show you the 4 major market equity markets here in the United States. And you've got the S&P 500 in the upper left, you've got the Dow Jones in the upper right, you've got the NASDAQ composite in the lower left, and the Russell 2000 in the lower right. As you can see, we actually have bullish intermediate postures. Now this is weakly bullish intermediate postures, not strongly bullish. So I hope we all know by now, if you've been watching this video long enough, that if the postures are considered weak, they can easily revert back to the other posture much more quickly. So there is that. But as of right now, we do have that light green background color over the S&P 500. Dow Jones Industrial Average, and NASDAQ Composite. So we have weekly bullish postures there as a result of the pretty strong push off the bottom that we experienced kind of starting last Friday. The oddball in the group is going to be your Russell 2000. As you can see, the Russell 2000 has yet to produce a bullish posture. It's continued to be bearish ever since this candle back here on February 21st. So it kind of refuses to follow suit with the larger cap indices that are out there. So anyway, remember that the Russell 2000 may not have as many strong companies within it. There's oftentimes a lot of mom and pop companies, a lot of times a lot of banks, quite frankly, as well. And as we've talked about in recent sessions, the banks have been one of the worst places to be. So there's not a lot of places to hide within the Russell 2000, whereas when you get into some of those mega cap areas, you see days like yesterday where Procter & Gamble and Coca-Cola and 3M and Walmart and those types of companies were just exploding higher. So there are certain areas from a large cap perspective that are kind of more of the defensive companies out there that have allowed those large cap indices to maybe not pull back as sharply as what you're seeing in the small cap universe, where you're taking on quite a bit more risk there. So I guess the takeaway here is, while we do have this weak bullish posture on 3 out of the 4 charts, I don't know how much I trust it. If I were to just to look at this candlestick action right here in the last week or two, I would continue to be nervous. You look at today's candles, and again, we were down over 3% in every single one of these indices here today, with the S&P 500 being down 3.39% as just one example. But you can see that we closed lower than the low of yesterday's candle. Some of you might refer to that as a close below the low of the high day, if you were to use yesterday as your high day, if you're using closing prices at least. So anyway, that's not positive price action there. It is true that in the last 4 sessions, which represent all of the trading of this particular calendar week, we have this candle and this candle, which were huge up candles, but you also have 2 above average down candles. And while we are still up on the week as a whole, you kind of get the sense that that big reversion to the mean move that occurred with the start of Friday of last week into Monday of this week is kind of losing some steam. It feels like it's starting to roll over a little bit. So we'll just have to see, because the other thing that we'll have to keep in mind is it does seem like this is a flip-flopping market where it's one day on, one day off. And if that's the case, then who knows, maybe tomorrow we get an up day. However, I think this is a market that is getting a bit more concerned going into the weekends. I think I talked about that last week as well, where when you have 2 days, Saturday and Sunday, when the stock market's not open, yet news headlines still come in all around the globe, and at this point we're making the assumption that most of the news headlines are negative, that just means that, who knows, maybe by the time we get to the stock market open on Monday morning, there's thousands more people infected in the United States with the coronavirus, and the futures are down sharply. So people are thinking about that in advance as they're trading on Friday, and a lot of more active traders might be kind of going to cash or closing their trading books on Friday, regardless of whether they have winning trades or losing trades in there, just because they don't want to take the risk of holding over the weekend. So we want to keep our eye on that. There's always that potential of kind of that domino effect rolling into the weekend. We've certainly seen that in crisis modes in the past. So it's nice to see those weekly bullish postures, but be very careful with them, I think, is the key there. Especially if you're shorter term oriented. If you're longer term oriented, looking for value out there, without a doubt, this coronavirus scare, I think we'll look back 10 years from now and say, yes, there was certainly value opportunities that emerged during that crisis. But if you're trying to be a nimble trader, then you've got to be a little bit more careful, because these winds of change seem to be blowing much more quickly from one direction to another each and every day. All right, let's go ahead and take a look at our 3 green arrows chart now. And this one will be chart 4D. So as we look at this, you can see that Russell 2000 does have 3 red arrows. That's what that pink background color tells us in this chart's case, telling us that we have price below the moving average, in this case a 30-day moving average. We have a red arrow on the MACD histogram telling us that we don't have any positive price momentum, and we have a red arrow down there on the stochastics telling us that we have been closing in the lower portions of the various trading ranges recently, telling us that the bears are in control of the chart. So the Russell 2000 appears to be the bearish, the most bearish of the 4 that we're looking at here. The other charts are showing you a mixed amount of signals. So in all 3 of the other charts cases, where we do have a green arrow is on the stochastics there. You can see it right there, and then right there, and then right there on the NASDAQ. And part of the reason behind that is, again, it's judging ranges. And because 2 out of our 4 days this week we close at the absolute tops of the candles, that does help support the way that the stochastics is calculated. So anyway, we'll see how long that lasts, but it is the saving grace in terms of the 3 red arrows versus 3 green arrows strategy, because without those green arrows on the stochastics, you'd probably have 3 red arrows on all 4 of these charts. As it stands right now, it's just the small caps that possess that. All right, let's go ahead and take a look, since it is a Thursday now. Let's look at the 1040 crossover method as well. So there it is, chart 4C, if you're following along at home. As a premium member, remember, if you're a premium member of Market Scholars and you want access to all 50 of the charts that David and I use, you'll just go over to our website Make sure you're logged in because the website will recognize whether you're a premium member or not. Hover your mouse over the Tools tab and then go down to Premium Resources, and then as you scroll lower there, you'll find the Thinkorswim charting setup tutorial. Anyway, as we look at these, you can see that things have changed very dramatically. In fact, this is one of the most dramatic 1040 crossover movements I've seen in the years that I've been tracking this. Typically, it takes a long time to have a crossover from a bullish crossover to a bearish crossover if we have some pretty extreme separation between the lines to begin with, and that is what I would say where we were earlier this year. This purple line directly below each of the charts will kind of give you a sense of how wide the gap was between the orange line and the blue line on each of the charts. The orange line represents a 10-week moving average. The blue line represents a 40-week moving average. And you can see right here, it was really just 3 weeks ago, we were at one of the highest peaks that we have ever seen, at least in the last 3 years, between those two moving averages. In fact, the only other time that it was even close would have been right over here in January of 2018. So we were at an extreme separation between the more sensitive 10-week moving average and the less sensitive 40-week moving average. So it's particularly alarming when we see that amount of separation and then the gap closing as quickly as it has. In fact, the gap is getting so close that on the Russell 2000, we could be talking about a bearish crossover there as soon as next week. I mean, it's quite remarkable to see how seismic of a change we have seen occur here recently. So brace yourself. We will likely be experiencing some death crosses on the 1040 crossover method in coming weeks and months. Russell 2000 is likely to cross over first, and then the others will probably come, maybe a couple of weeks or, within a couple of months later. So brace yourself. It's possible that is going to occur, unless we have some sort of miraculous turnaround here, which, as you can see, when the Fed lowered interest rates by 50 basis points earlier this week, it didn't really do much to help the market all that much. And there's expectations. I saw Jeffrey Gundlach on CNBC today mention that he and many other market participants are expecting another 50 basis point rate cut here in coming Fed session. So, this is a market that is in crisis mode, and money is fleeing away from some of the riskier areas and trying to find safety where it can, even though it's a very difficult job for it. And where we are finding that safety, this would be a good time to transition over to our 5 grid for the asset classes, or actually the 12 grid for the asset classes, this chart 5A, where we are finding the safety trade is in treasuries and in gold, right? So there are areas on this chart that are on this 12 grid that actually look like they're strong trends. And I would say that those strong trends from my eyes perspective would be long-term U.S. treasuries, ticker symbol TLT, foreign bonds, which is BNDX, and gold, which is GLD. Those actually have strong trends behind them. So as the market, as market participants are fleeing riskier assets like stocks, that money needs to go somewhere. And right now it appears that the money is flooding into the bond market and to gold, which are oftentimes kind of viewed as more of a safety type of a trade. So anyway, as you look at some of these other charts, we do have light green backgrounds on many other of the charts, but you'll also notice that in the case of the S&P 500, EFA, EEM, PFF, VNQ, and HYG, all of those have light green backgrounds, but they also all share the commonality of a red moving average. Remember, that moving average turns red when price falls below a falling moving average. And so generally the concept there is the path of least resistance right now is to the downside on those types of charts. but along the way there will be some posture changes just to kind of test the system to see if there's any bulls out there to kind of hold the levels. If the bulls can hold the levels, then they can, technicians can work off of that as a bottoming process starts to be formed. But right now it is anybody's guess whether that's actually happening or whether we're going to wake up in a couple of weeks and see stocks below where they were trading last week on Thursday or Friday. So right now all bets are off when you've got a downtrending moving average, because that can easily act as resistance if we do get some minor reversion to the mean types of moves higher. So just got to be awfully careful in this type of an environment. Now oil is getting smoked here today as well. It was down 2.5%. Oil stocks have vastly underperformed oil itself, which is a little bit nerve-wracking to a lot of market participants. There's a feeling that something is wrong with a lot of the oil stocks, as though we're going to see a lot of skeletons come out of closets in coming months and years, whether that happens or not, or if this is the ultimate buying opportunity of a lifetime. We'll find out at some point. But what I can tell you is that oil stocks have gone down dramatically more than a barrel of oil has, and that typically doesn't happen all that often. Also be aware that U.S. dollar was down again today. That's been a pretty nasty drop off here in the last 2 or 3 weeks on UUP. And then I mentioned this briefly before, but I'll just reiterate it here. The TNX is now clearly below 1%. Remember, you need to move that decimal point over on TNX chart, at least here on the Thinkorswim platform. So you're looking at basically 92 basis points on for your yield for letting the government hold your money for 10 years. That's almost unheard of. Obviously, that is a historical all-time low yield for the 10-year U.S. Treasury that we're dealing with right there. And of course, that pressures the financial stocks out there. I know a lot of banks were down, 3 to 5% yet again today after suffering really nasty corrections up until this point. So things haven't gotten any brighter for the banks, and I don't think they will until we start to see some stabilization in this Treasury yield. And right now, it just seems like the rates go down every single day. You can see here, if I were to count out the candles, let me right-click and maximize this so we can see it a bit better. But 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That's 11 straight down sessions for interest rates. I'd be curious how many times that's ever happened. So I'd have to believe it is incredibly rare. Last time we had a day-over-day up move was this candle right here that's outlined in black, and that was way back on February 19th. That's like 3 weeks ago. So remarkable move in yields to the downside there. All right, let's go ahead and take a look at another 12 grid here. In this case, we're going to go over to the U.S. sectors, where we did see another disastrous day. As always, there are going to be some areas that look better than others, but all of our sectors were lower today. If I'm looking at this correctly, it looks like XLU was the best performer today. It was only down 1.54%. The worst performer looks to be those, might have been industrials here now that I look at it again. I was about ready to say those banks and those brokers. XLF and industrials were effectively a tie. They were both down about 4.8%. Industrials were down just a hair more. They were down 4.89%, whereas the financials were down 4.82%. But, remember that the transportation subsector belongs to the industrials sector itself. I'm bringing that up because today was a day where a lot of airlines got absolutely massacred, and saw some headlines that Warren Buffett's having a rough go of things. As a lot of people know, Berkshire Hathaway owns stakes in 4 major airlines, so without a doubt, it's feeling a little bit of pain over in that portfolio, as a lot of people are, thinking twice about hopping on an airplane. I've got a trip coming up here actually in just a couple of weeks, and meeting up with some of my college buddies, and starting to get some of the emails like, hey, are we still doing this? And so it's out there. It's real. People are truly thinking about just canceling trips. And remember, we're about ready to get into spring break for a lot of folks as well, and other types of family vacations that might be taking place. And people might just decide to, you know what, it's not worth the risk of getting on an airplane. We're just going to hope that the airline will reimburse us or just eat the cost ourselves because it's not going to be worth it for us. So a lot of those airlines are feeling significant pressure here specifically today, and then that caused some internal chaos there with industrials. Whereas I mentioned before, the reason behind the financials, with interest rates continuing to go lower, that's just going to be the path of least resistance for those financials there. So anyway, as you can see, the worst place to be, it continues to be energy. Energy was down 3.66%, and you can see it still has a strongly bearish posture. That's what that darker pink background is telling us right there. All right, let me go ahead and take a quick peek at the major economies out there, and that would be chart 5E. So as this comes up here, you can see that most of these trends continue to be lower. In fact, every single one of those 12 charts in front of us have a red moving average telling us that price is below a falling moving average. So path of least resistance continues to be to the downside. There are a few charts that are able to hold up a little bit better. Interestingly enough, China is actually one of the areas that's held up a touch better than other markets around the globe. And perhaps one of the reasons behind that is, maybe China's getting beyond the coronavirus at the same time where the rest of the world is now taking on that burden. I don't know if that's for sure, or if it's just government stimulation, or what's supporting the markets there. But I can tell you that the Chinese markets have actually held up a little bit better than many of their other foreign market counterparts that are out there. But there's some pretty ugly charts. As you can see, India was down 4% today as just one example, and it plunged to new multi-month lows with that 4% decline. So it's hard to stay out of harm's way in this era. If you're looking at stocks, I don't care if you're looking at them in the United States or across the globe, many markets are really struggling. This is a global crisis that we're dealing with. This is not just something that's confined to one country. We all have to kind of share in the responsibility of getting through this coronavirus situation here. All right, so with that out of the way, let's get into our trade application example here for tonight. And for that, I'm going to come on over here. First, let me start the conversation with coming over here to the monitor tab and coming down here to where we have our longer term stocks for this particular paper money account that I use for these market outlook presentations. As time goes on, I try to selectively add to my long-term portfolio. This is the same conversation I gave you exactly 1 week ago, right before we bought Walgreens, right? So we bought 200 shares of Walgreens at about $45.48. Same conversation I'm going to share with you this week, which is when we have chaotic moments in the marketplace, as tough as it is to do, you got to reach down deep and try to force yourself to find something to buy. Now, of course, that's not a recommendation. I don't offer you a recommendation. I'm not your licensed financial advisor or broker dealer, but I'm just saying, if you fancy yourself a long-term investor, as I do, it never feels good or comfortable to buy when prices are the best, right? There's a reason why Buffett always says, buy when there's blood in the streets. That's when the best values emerge. So if we are to think long-term, and I'm not talking about next month, I'm talking about 10 years from now, will we look back at the year 2020 and say, yes, there were opportunities available if we could have just stepped aside from the chaos and the panic and tried to think about the future as opposed to the next 3 hours. Now, some of you have portfolios that are set up for that. Others of you are just in more of a trader mindset. So, to each their own there. More often than not, we do focus on shorter term opportunities for this particular video. But when we have extreme meltdown days, like today was, another kind of 10-to-1, more losers than winners type of a day, those are the days where I want to go to work and look for an opportunity when we see one. And so traditionally what I do is I try to look at how is our long-term portfolio established currently, and then I try to look for dividend aristocrat types of companies that we don't have any sort of exposure to yet, and then see if now might be a good time to add a little bit of exposure to. So remember, this is not a safe strategy in terms of buying a stock right now in the heart of the chaos. But when you combine it with selectively adding to other chaotic times throughout history, and you're always concentrating on higher quality investments, I do have a belief that that type of mindset will lead to good outcomes in the future as long as you have patience. Now, each person is a little different there, and some people don't have the patience and they're not going to be able to withstand, let's say, a 15 to 20% pullback or what have you. So everybody's a little bit different there. But as I looked at this portfolio here, I noticed that there were a few aristocrats that have higher yields right now that we don't have exposure to yet. Of course, we have exposure to, Procter & Gamble and Pepsi and AT&T and other aristocrats. But one that I noticed that we don't have is Nucor Steel. You can see here, this is in alphabetical order, so it goes from M to P. We don't have any ticker symbols with the letter N. So I'm going to come over here and show you what caught my eye with Nucor here today. I'm going to pull up chart, let's do 2A. And the ticker symbol for Nucor is NUE. And this is a company that is a dividend aristocrat, as I mentioned earlier, meaning that it has raised its dividends for at least 25 years in a row or more. In Nucor's case, I believe their dividend streak is 47 straight years. And that doesn't guarantee anything, so keep that in the back of your mind as well, which is, again, why you don't just buy one stock for the long term. You buy a portfolio of stocks for the long term, just in case this is the one that ultimately cuts their dividend and goes bankrupt at some point. That is a possibility. I hope that's not the case, but it's always a possibility. So Nucor, with their 47-year history of raising dividends, has told us that they raised dividends in 08, 09. They raised dividends in the dot-com bubble. They raised dividends in the great, inflationary era of the 70s and 80s, and then going back through the Vietnam War, et cetera, et cetera. So this is a company that's been through some tough times in the past and has generally rewarded shareholders that stuck by its side. So you try to take advantage of companies like that when they sell off hard. Now, how hard is always a difficult question to answer. What we use in my dividend growth investing classes is what's known as the dividend stair-step chart here. This is chart 2A. And we use an average high yield theory to try to determine when are better times than others to be purchasing these securities. And as you can see, with this sell-off that Nucor has had here recently, it pushed us down into this blue zone of this chart. What that is telling us is that its current yield, which is very close to 4%, it's almost an identical yield to what Walgreens was a week ago, as a matter of fact. So they're both right around 3.95%. And then we compare that to what is its average yields throughout history. And typically it has an average high yield of 3.73%. So if you're able to get a yield better than that, history has suggested that those were good times to be selectively picking up shares of this for the long term, not for the next 3 weeks, for the long term. Now, as you can see, another interesting thing has developed here. Underneath the bar for this week's candle, you will see a green dot. It's right kind of to the left of my pencil right there. That green dot signifies that this company also has an oversold cluster signal on a weekly candle chart. So this is a 10-year weekly candle chart that we're looking at right here. So on a weekly candle chart, we have an oversold cluster signal right here, right now. You can see that we've had a few of those over time. Now, if you were to look at all the dividend aristocrats under this kind of microscope, you'll find that some of them produce more clusters than others, and a lot of it is just due to how cyclical they are. Remember, steel is a very cyclical business. This is a riskier venture than what we did a week ago with Walgreens in a lot of people's eyes. So be aware of that. This is a cyclical business, and you have to deal with the ups and the downs of that business. The more cyclical the business, the more likely that the stock price is also volatile, and the more volatile the stock price, the greater the chance is that you're going to see, extreme prices to give you overbought or oversold cluster signals. So one advantage of looking at a chart like this is we can kind of get a sense of some of those extreme times throughout history, and one of them is happening right now. Now, similar to Walgreens a week ago, another thing caught my eye with this. So if you'll allow me, I'm going to switch the time aggregation period. So I'm coming over here to the time frame, and rather than looking at 10 years weekly candle chart, I'm going to change it to 10 years monthly candle chart and hit OK. So what that does is it changes that aggregation period where you have a lot fewer bars, because now every single one of those bars represents a month rather than a week. And as you look at this here, you'll notice something that happened last week with Walgreens as well, which is we have a very rare oversold monthly cluster on Nucor steel as it stands right now. Now, with Walgreens a week ago, I was a little bit more confident in saying that that was going to end up being a cluster because we were at the end of February last week. With this being the first week of March, remember one of the possibilities is if Nucor does rally for the rest of March, it's possible that little dot will disappear by the end of this month because these are monthly candles. So do keep that in the back of your mind. But as of this moment in time on March 5th, we do have a monthly oversold cluster signal. And as you can see, there was only one other instance of that in the last 10 years, and that occurred right here in September of 2015. So while that's not a guarantee, it's actually a way for you to kind of get a sense of what occurred after that moment in time. Would have you been better off buying or selling this stock on this candle? Remember, technicians might have very well been selling this stock on this candle because they would have seen broken support levels and all this stuff. But had you instead turned the tables and bought for the long-term perspective, you would have been a little bit better off. Now, obviously, things have come down quickly here recently, but this company has continued to pay dividends at higher and higher rates all along the way as well. So had somebody bought back here, they would have seen their stock price go up the very next month. Now, keep in mind, it was maybe 2 or 3 months later on this candle in January of 2016 where that low was breached. So remember, if you're buying Nucor today, doesn't necessarily guarantee this is the bottom. You might have to deal with additional downside pressure. But if you can kind of get into that mindset that this is in the approximate range of a bottom, even if that process is going to take 4 or 5 months, and if you look back 10 years from now, you're going to ask yourself, would have you rather bought this company down here at 40, or would have you rather bought this company up here at 70, right? And I think you know the answer to that. So again, not a guarantee. This company, for all I know, could end up being a $20 stock a year from now. But using history as our guide, you can see why there would be a reasonable chance for us to take this opportunity to invest in a very cyclical business when there is now blood in the streets. So I'm going to come on over here to the trade tab, and let's just go ahead and buy 250 shares, nice round number there in this particular case. And let's just say that we'll leave it in there at 41.04. That way, if it gaps up just a little bit tomorrow, we'll be okay with that. But it actually closed today at $40.77. So let me go ahead and click confirm and send. Spending about 10 grand on that, and we're going to send that in and see if we can add that to our long-term portfolio. All right, well, thank you for joining me here yet again. Another ugly day in the market. Continued a theme of very volatile trading sessions that we've been experiencing here recently. Russell 2000 continues to have a bearish posture. The other markets are trying to hold on to a degree to a weekly bullish posture, but I wouldn't trust those postures so much right now because they all are below falling moving averages. And so this market has a feel that it's not over yet. It has a feel that it's still trying to work itself out. So if you're a short-term trader, you need to stay nimble, set your stops, and get out where you need to. If you're a longer-term investor, as I explained here at the end of tonight's video, look selectively for those opportunities where you can fill in holes in your portfolio where you were lacking exposure before. So with that, I wish you all the best success with your trades and your investments. If you got value out of tonight's video, be sure to click like for me over on Twitter, and David will be back with you tomorrow. Take care, everybody. Bye-bye.